Hello, Mark Ostwald from ADM Investor Services International with a few thoughts on the Federal Reserve meeting that we had this week and how markets performed during January. It's been a remarkable turnaround from Q4 when everything was doom and gloom and people were worried that the Fed was going to over-tighten. And obviously the Federal Reserve sent a very clear signal this week that it is going to be on hold for a while. Why did it change its view? Well, if we have a look at my first chart today, one which I post up very often, it's the US Financial Conditions Index. As we can see, we peaked on that in terms of the peak being a much tighter set of financial conditions and moved down being looser financial conditions. We peaked on that back in December. And ever since, and primarily, above all, due to a big fall in volatility above all in stock indices with the VIX index down 1/3, we have seen a quite dramatic fall in the financial conditions index, though it has to be said we remain well above the levels that we saw for the bulk of last year between Q1 and Q3. Clearly, that peak back in financial conditions is one of the things which drove the Fed to change its stance. But unfortunately, the Fed finds itself now in a very unfortunate position, namely that it is hostage to the way that financial markets perform. And for a lot of people, they'll also be thinking that part of the reason for them moving to a pause was the political pressure. This is not a great place for a central bank to be. But nevertheless, be that as it may, one also has to make the observation that a lot of the incoming economic data, perhaps not so much out of the US, but certainly out of the Eurozone, out of China, and China's effectively satellite economies in Asia, has not been great. So why the big rush that we've had for riskier assets? We've seen the Dow up 7%. And that improves as we go through up to the Russell 2000, which was up almost 11%. Oil's up 19%. Gold was up about 3%. So we've seen basically a fairly big rotation out of defensive assets into riskier assets. And that's in no small part driven by the Federal Reserve's decision and the anticipation of it. So let's go to the next chart. Which is the performance of the US dollar index. I've got that mismarked, sorry about that. It's the purple line is the US dollar index, the white line is the JP Morgan Emerging Market FX index. And basically one can see that along with equities in the United States and most other markets, we've seen a fairly solid performance by emerging markets, which is certainly understandable given there is considerable carry in interest rate terms. And the emerging market growth is likely to be benefit from the fact that they're not going to be under quite so much pressure from rising US interest rates when they're refinancing. So I come to my final chart, which is the Chinese CNY CFETS index. This is the FX index that the People's Bank of China targets. And remarkably, despite the weakness that we've seen in a lot of Chinese indicators, be that PMIs, be that the monthly indicators, we've seen a notable improvement. And that comes also despite the fact that the Chinese authorities have actually been loosening monetary policy and certainly loosening fiscal policy. It's probably an acknowledgement that China is basically looking to come to some sort of agreement with the US, and that will power, in the short term, better sentiment in risk assets. But we need to be careful that the deteriorating picture on global economic growth doesn't catch us out at a later stage in this quarter.